Trade strategy I'm going to show you. Now, this ultimately does come from the footprint course. Today we're going to talk about one of the 10 strategies being auction imbalances. I'm going to show you what it looks like on a footprint, what it means, what it implies, and ultimately what the edge is that you can develop around auction imbalances. That being said, also we're going to pull out a low volume area anomaly strategy. This is a volume profile strategy. So I'm going to show you both these strategies, a lot of similarities, but in essence they are standalone strategies. Okay, so you don't have to be proficient with profiling and footprint. You can be proficient with one and execute the strategy depending on which tool you fully utilize. Okay, that being said, guys, you can see there are a host of different trade strategies. I mean, we've got 10 footprint strategies and I've got 12 different profiling strategies that I'm going to show you. That's 22 unique standalone strategies. Okay, now they're covered in full in both courses. However, and this is imperative, you only need one of them. Okay, you only need one out of 22 strategies to master, to become very successful as a trader. Okay, don't be fooled into thinking that you need to learn all these strategies. More importantly, don't be sucked into trying to trade all of these strategies. Okay, some of them will suit you, some of them won't. Some of them will make sense, some of them won't. Okay, when it does make sense, make sure you develop that strategy, as I'm going to show you in the next couple of slides. Okay, so let's get into it. Today's strategy is a low volume area. Now, we're going to talk a little bit about principles on one of the next slides, but this is what we have. It's a perfect example. It comes out of the GBPUSD, a market that hopefully a lot of you do trade. And the key thing we want to take away from this is what a low volume area or an initiative area looks like, which I'll show you on the footprint chart. So we can see two different profiles. This is obviously yesterday being Monday the 4th, Monday the 6th of June. Sorry, Monday the 4th of June. This being Tuesday the 5th of June today. And what we're looking at are low volume areas and these things called anomalies. So a low volume area can be identified as two things on a profile. One, as a set of single prints, which identifies the TPOs, or as a low volume traded area. In other words, an area that has a very light or limited amount of volume being transacted between buyers and sellers. And we can see that right over here on the same area. Now again, we come into today and again we've got a low volume area being identified as single prints and also volume. Now, what I will say, make no mistake, you can have a low volume area, that ultimately can be high volume, and vice versa. You can have a set of single prints that could be, low volume or high volume. So they don't necessarily always come in conjunction. Sometimes they can come individually, but more often than not, you're going to find them together. Now, what is the basic premise of this mean? What is this, why do you need to be able to identify these anomalies? What do they mean in terms of strategy? Okay, the simple essence of it, okay, and this is a very oversimplified interpretation, but the simple essence is when you've got this low volume area or single prints, it acts as a barrier, in the market. It acts as almost like a carpet of support in this instance because the single prints are coming from the downside towards the upside. So in essence, what it means is that there was a very strong aggression taken from buyers in this market today on the 5th of May. They've pushed prices higher and they're holding those prices higher with the sellers unable to transact in that low volume area. Okay, now the basic strategy, what we're looking for is we're looking for the longer this holds, the longer the market fails or the sellers fail to get into this untraded area, the more likely is that we're not only going to just test higher, but could even then continue through yesterday's highs. Okay, that's the basic premise of what the strategy implies. Okay, now whenever you see a low volume area or you see a set of single prints, you always want to be aware of it, not just because of the trade strategy I've just interpreted for you, but because also it presents a second tradable opportunity, which is an unwind of short-term positioning. So what we mean by that is, if these sellers do, in this example, do begin to get, a little bit of a foothold in the market, they do begin to sort of, put the buyers under pressure and they re-enter these low volume area or single print area, the tendency is to not just fill it out, but then also begin the process of filling in this area. Okay, as a rule of thumb, low volume areas tend to then become high volume areas. Okay, let's recap. Trade one. We're looking for a continuation to the upside so long as this sets a single principal low volume area holds. Step 2, if that fails and we re-enter that range, we're going to see the market not just trade back down towards that lower 133.34, but also begin the process of filling out. So filling out, we simply mean consolidating within the 133.34 range to 133.54. Okay, that's our two plays on the profile. That is our profile strategy with regards to the anomaly of low volume areas or single prints. Okay, now on the footprint, similar concept, except we call this initiative being taken in the market, or an imbalance created by initiative. Okay, so what that means is we can see that the market, obviously over the PMIs today, we got quite an aggressive little bid up in the PMIs, a very strong number. Now note, we can see a big pickup in the volume, and we can see price direction towards the upside. Now, the key difference between the two is not necessarily what the outcome of the market is, it's how you approach the strategy. In other words, what we're looking for on the footprint, which the profile doesn't reveal, is this pockets of interaction between the buyers and sellers. And you can see this with the first little area I've highlighted. So, for instance, if you come back, you can see that there was a large order filled around the 133.60 up to 133.66. Okay, now what this tells us is that this is the point where buyers met sellers, sellers interacted and engaged, but ultimately they got overwhelmed and prices continued higher. Now we call this a bit of pocket positioning, something that's discussed quite extensively in the footprint course. Now, what I will say to you is there's a high probability or tendency for the markets not just to retest this, but also utilize this as S1 or support. Okay, make no mistake, if you were to look at cable now being 1 o'clock in the afternoon, this is exactly where the market is battling around. Okay, it's battling around this 133.63. The buyers are definitely holding on to this position, so as long as this holds, we remain buyers for a retest of that high at 133.90. If they overwhelm this position, again, we stop out and the market should then flood back down towards 133.45. Okay, now what you should note about both these strategies, if I show you this and if I show you the second strategy, the risk is defined by the strategy. Okay, in other words, we're not stopping out where we lose too much money or it feels uncomfortable. The risk is where the strategy is invalid. Okay, so if this is the pocket position in a footprint, we're simply placing our stop in and below that. So 133.55 is a sufficient stop to allow this trade to validate itself. Okay, so we have roughly, call it 8 ticks of stop, looking for a retest of the high at 133.90, which gives us a good 30-tick winner. 8 ticks for 30 ticks, risk reward makes sense. Okay, and this is how we approach every one of the 22 strategies I'm going to show you week in and week out. All right, now the principles. Okay, the first one is trade location. Now, it's very, very important when you're talking about both the the footprint or the profile, is where are we trading relative to the previous day. Okay, we have three basic interpretations of trade location. Again, I'm going to give you a basic understanding. If you've taken the course, this should all be very familiar to you. If you haven't taken the course, that's definitely something you want to consider. However, trade location, we always want to have a look at where we are trading today, okay, relative to yesterday. So I'm going to call yesterday -1 and today 0. Now, that trade location can either be balanced or it can be imbalanced. Okay. Now, a balanced trade location is simply where today's range is trading within the previous day's range. Okay. Now, it doesn't have to be 100% within. If there's a small extension on a previous low, that is still within the range. Okay, whereas imbalanced is simply a market that is having some form of an overlap. Okay, so we can see there is a bit of trade that facilitated within the previous day's range, but also trade facilitated outside of the previous day's range. Okay, so that's the first principle you always need to consider with regards to developing strategies. The second is initiative. Okay, where is initiative being taken? So we saw in the pound, initiative was taken within the previous day's range. Now that's important because that's telling us that buyers stepped in even though we were trading in a balanced market. Okay. More importantly, it tells us that the buyers were responding not technically necessarily, but rather to the economic data. Okay, now initiative can occur in a number of places. It can occur within range, it can occur out of balance, it can occur for a number of different reasons. And it's important that you interpret where this initiative occurs so that you can then make an understanding and strategize as to where the next potential trade opportunity may come. Okay, the last one is volatility, and this is something we deal with quite extensively, and it's probably for me one of the most important principles to understand for a lot of my strategies. Okay, volatility is just simply where does the market's price range expand. In other words, if we were looking at 5-minute candles for the last 1 hour and we saw that on average the 5-minute candle was 10 prices, okay, we know that the moment the market suddenly goes to 20 prices within a 5-minute, there is a shift in volatility. Okay, volatility does not imply trend, it simply just implies a greater variance over which the market is trading, or a greater number of prices over which the market is trading in a given time frame. Okay, now it's important to understand where volatility is coming in, because that will indicate to you the time frame players in the market. For a basic example, okay, if we have a very important swing high that's been there for a number of months and we're about to break out, if we get volatility expansion around that high and we sustain the break, it's telling us that there are large time frame participants in the market, hence the volatility. Okay, now when we start to interpret the different time frame participants, that will allow us to again strategize according to the market information. All right, so that's our trading principles. Now, once you've got those trading principles grasped and you've done the various strategies, you've had a look at them, we then take them and we begin to template with the strategies. Now again, this will look very familiar to you if you've done the profiling or the footprint course, but templating in essence is a way that we can take the information that the market showed us every single day and ultimately begin to develop an understanding as to what creates that strategy and ultimately what makes that strategy successful or not. Okay, so typically a template, we always want to start off by drawing this strategy, and the reason is that when we draw a strategy like a low volume area, we can very quickly begin to remember and interpret these strategies. Okay, we've got that low volume area in the cable, we know that we expect a retest of the high. If we don't get it and we fail, we know we expect the market to sell off and balance out. Okay, so straight away we've got a hypothesis. Number 1 or number 2 is likely to occur. So we draw the strategy so that we can recognize these strategies and remember the opportunities when they occur. All right, the second thing is we then wanted to start observing the strategy based on objective facts. Okay, so we take the facts that the market shows us and we begin to implement them into our template. For example, okay, we take that pound again this morning and we say to ourselves, where did this low volume area occur, or this imbalance occur? Did it occur in trending conditions or in a consolidating condition? The simple answer is we're within the previous day's range, therefore it is in a consolidation type market context. Okay, and we do the same. We answer all these questions based on the trade strategy we're trying to develop. When we do this day in, day out, what you're going to begin to recognize is that, certain trade strategies will work very well in certain contexts, but very poorly in other contexts. Okay. Now, the best example I always like to use is a breakout trader. Right? People sometimes cannot understand that. Why does the market sometimes break out so clean and so aggressive and such big opportunity, and then other times it's very weak and very limited and lack of volatility? Through creating a template and completing the template day in, day out, you will begin to recognize when a trade strategy is a A+ strategy and when it is a C+ strategy. Okay, now once we've got all that understanding, we've developed the templates, then we start to look at execution methodology. In other words, where do we execute? How do we execute these trade strategies? How can we make money out of these trade strategies? Okay, very simply put, in terms of the low volume area, as I mentioned, we're looking to be a buyer of those 133.60s, because of the low volume and also because of the absorption on the footprint. So we're looking for an execution around the 133.60, targeting a retest of the highs up at 134 with a stop at just below or at the point where the trade strategy is invalid. Okay, like I said, once the market begins the process of filling out these single prints, it's likely to fill in down all the way to the 133.40 and begin the process of consolidation. Okay, in terms of obviously our footprint, yeah, you can see very obvious. Note the absorption here taking place at that 133.60 as I mentioned earlier, and we can see a second test of it a little bit low, 133.57. The seller's really struggling to get a foothold around this area. So long as this holds, the market probability is towards the upside. Once this breaks, watch out for the flush below.